So I'm going to revisit Lightspeed Commerce Inc., symbol LSPD on the TSX. Trades around $17, $2.5 billion market cap, doesn't pay a dividend. But what does Lightspeed do? They're based in Montreal, Canada. They are a cloud vendor of omni-channel point of sale software to retail and hospitality customers. Software is used by 160,000, greater than 160,000 mid-market customers in North America, Europe, and Australia. Their applications power single and multi-location retail, restaurants, golf course operators, and other businesses to compete successfully in an omni-channel market environment by engaging with customers across online, mobile, social, and physical channels. The company primarily targets small and medium-sized businesses. Now, Lightspeed, let's look at the chart over the past 5 years. It's down over the past years around 65%, 89% from its September 2021 highs, which was in the range of $158. At the time, as the stock was climbing up, we called the valuations on this stock ridiculous, as the company was not profitable at those stages. Again, Lightspeed has proven to be an excellent growth company in terms of its revenue. It's light years ahead of most Canadian public companies in terms of revenue growth and the trajectory there. We can see in this table of revenue growth over the past 8 years and the trailing 12 months figure there over the past 12 months. From 2014, when Lightspeed posted $39.9 million, the company has grown its revenues over the past 12 months to $1.32 billion. That's tremendously strong growth. But even with all this promise, when the company's valuations touched, and when it got up in 2021 2021 to September, it was $23 billion market cap on the stock. The near-term efficiencies of the market at this point were on full display. Again, a promising company, but this was irrational exuberance, particularly as the table shows. The company's operating loss has mounted over that period from $35 million in 2024 to $213 million over the past 12 months. But the profitability is improving, and we take a look at the progress in the recent reported Q1 fiscal 2025 numbers here, highlights. Revenue was up 27%. Transactional-based revenue was up 44%. Subscription revenue increased 6% year over year. But the net loss was there, 23 cents per share. It is an improvement from where it was last year at 32 cents in the last quarter. And adjusted per share is also an improvement, adjusted net income. Adjusted EBITDA was $10.2 million on the positive side versus a loss of around $7 million in the same period last year. Let's look at the outlook. Stocks are always trading forward, so we're looking at what this company is going to do in the next quarter and the next year in terms of management's guidance. Second quarter 2025, revenue is expected to be approximately $270 to $275 million. Adjusted EBITDA of $12 million, so up from what we saw in the last quarter, where adjusted EBITDA was $10.2 million, so sequentially up. Now, for a little bit of color here on Q2, for the second quarter, management expects to see similar trends to the first quarter, with sales growth coming predominantly from transaction-based revenue as the company continues to expand adoption of its payment and capital offerings. For the second quarter, year-over-year growth, the company is lapping a significant revenue uplift due to its the surge in unified payments, customers becoming live last year, so it's got some tougher growth comparables. Furthermore, Lightspeed's initiatives aimed at growing software sales will only partially be impacted in the coming quarter. Expects more of an impact as we go through the year. For the full year, we can see the guidance here. Revenue growth of at least 20%. Adjusted EBITDA of a minimum of $45 million. Now, most analysts currently expect them to exceed $45 million. Let's look at the balance sheet here. It's very strong. Cash, $673.9 million. That is down from $722.1 million in the preceding quarter. There's no debt in the business, so the net cash is, sorry, that's the wrong figure. The net cash there should say $673.9 million. That is the figure from the preceding quarter. Now, here is the trend the company, the company is investing in growth, so you can see its cash moving lower, but a lack of free cash flow. With this lack of free cash flow, the balance sheet, the cash on the balance sheet has moved 29% lower over the past 2 years. The market expects Lightspeed to be free cash flow positive in fiscal year 2025, so this may break the trend, which would be a positive. Let's look at the valuations here. Enterprise value to revenue over the past 12 months is 1.4. We don't really love that metric, but there's no earnings here, so it's hard to you can't give a PE, and the cash flow is very low, so it's a very high multiple off that. EV to adjusted EBITDA based on fiscal year 2025 estimates around 29 times. Again, the PE, there is no earnings, not even forecasted for this year on a net income basis, so cannot calculate that. Conclusion here: following a promising Q4 fiscal year 2024, Q1 fiscal year 2025 was a positive. The fiscal year 2025 guidance states the business can grow at a greater than 20% clip organically. That is a tremendous growth rate organically. Organic is what we look for in terms of a business. It's great to see. And it will drive better than expected margin expansion. We think that it will over time. Again, like I said, we're impressed by the strong organic growth rate, a metric we prescribe a higher degree of value to than some other growth elements, like say growth by acquisition. On the flip side, while adjusted profitability is moving in the right direction, I stress that it is only adjusted profitability. The guidance still implies just a 3.7% margin, which is very low. We reiterate our opinion that Lightspeed dropped the ball by not focusing efforts on producing cash flow years ago, and its current profitability margins remain rather pathetic and hold back the stock from moving higher near term in a market that is not assigning premium value to payment processing companies without solid free cash flow and net income margins. The stock trades at, again, 29 times EV to its fiscal 2025 expected EBITDA on an adjusted basis, which again, that is very high. The growth and strong balance sheet is intriguing, but we find growth with real profitability elsewhere. And in the near term, we're just monitoring Lightspeed.
Yeah, it's nice to see. I mean, profitability moving in the right direction. Again, they're still losing money, but again, it is nice to see at least it's in the general direction. The amount of times that we get individuals bringing companies to us where, they'll ask, how do you like this business? Revenue growth is absolutely tremendous, but again, losses are scaling with revenue. That is a massive red flag. Again, we're not in, like Ryan said, on Lightspeed yet. But again, we'll see what 2025 holds. We'll see, especially, cash flow or free cash flow. Again, they probably won't be able to generate, but moving in the right direction.
Yeah, over time, I would see like this company has room for margin expansion, like meaningful margin expansion as subscriptions accelerate, payment penetration rises, capital expands, and like operating costs are controlled. And you're seeing it move in that direction, but they're not there yet. And you're still paying like 29 times forward EV to EBITDA. On a free cash flow basis, this company, the estimates out there, for them to make 9 cents or something. So you're paying $17. The multiple off of free cash flow is still massive. The balance sheet is great. Again, sometimes, and I've talked about this before with Lightspeed, it's a double-edged sword. When a company gets a strong balance sheet through raising equity, for example, rather than disciplined free cash flow generation, and they have never achieved profitability, they have that. It's kind of like a crutch for the business. And we see that. I'm not saying it has to be what's gone on here with Lightspeed, but we often see it as a crutch. And because they don't need to meet payroll each quarter, for example, by generating cash flow, they can invest, they can do whatever they want because they have almost too much cash, this business. They've never had the discipline to create cash flow. I remember a couple of years ago when they, set out their course towards profitability. And again, that course was towards adjusted EBITDA profitable, so not actual profitability. But it was a 4-year plan basically. Well, the market, it was a 3-4 year plan. The market over that time has said this is not good enough, and the share price is just, and people who are watching this can argue with me, say Lightspeed's a great company, look at the revenue growth. The market is telling you it's down 89% from highs. It's down significantly again this year as they come out and start to hit adjusted profitability. The market doesn't care. I mean, they're telling you it's down 34, 35% this year. There's been many small to mid cap companies that do process or produce cash flow that have done tremendously well for our clients in our research. If this company had a disciplined approach to producing cash flow, I think the valuations, the stock could be higher. But you're talking about a margin, like I said there, I think it's 3.7%. That is a very low margin. We fret over businesses with 10% adjusted EBITDA margins all the time. Now, again, I think Lightspeed could ratchet back some areas of spending, and you could have a higher, but again, they have to do it. We see companies that spend, generate free cash flow, trade at reasonable valuations, and continue to grow over time. This company has the organic growth that's really moved up that we like to see. But, if they pull back on the spend to grow the client base, how profitable really are they? Or how much organic growth can this business naturally have? I question those things until we see organic growth combined with significant cash flow generation. And you're just not there yet.
Yeah, and one thing I would add is even on their revenue growth, their gross profit margin actually has been declining over time. So they're taking on less lucrative sales, which pumps up that revenue. Yeah, sure, that looks good, but you're not getting that same economies of scale if even gross profit was flat percentage, if it was 1-to-1. And then you get that operating income, and that's where that leverage comes in because those are relatively fixed. You're not getting that same degree here. Yeah, you're getting leverage on the operating because it's still relatively fixed asset, but when you're getting less of that variable expense over time, you'd have to look into the exact expenses because even though that's your traditional is you consider the cost of revenues variable, it's not always true. You'd have to look into the exact structure of it. But when you're seeing it decrease year over year, quarter after quarter effectively, that's a bit concerning because it can just mean the only way they're increasing revenue is lowering their incremental sale price. It's as simple as that.
Yeah. And those are the things that concern us with the business. It's pointing in a better direction than it was, 2 years ago, for example. But, that operating margins should come up over time, and we're not there. We're not there. And still, even you just look at the adjusted EBITDA multiple on the stock, it's 29 times. It's a high multiple. We've found many companies that are trading at a half to lower that are growing, that have good balance sheets as well. And that's the discipline that we have when we're recommending companies. And that's what's had us out of Lightspeed and not, and told our clients to avoid it. And we're very happy we have over the past 5 years.